so exciting to get back about 14 years back. 14 years is when I joined the corporate. And 14 years back, I used to be in classrooms like this, but in person. Virtual was not even thought of. Okay. You know something? I have something interesting to share with you. The time that I shared my profile was some time back with i3. And incidentally, just in the last 3 weeks, I've received my new title, which is the next level, which is Operations Manager. So I would like to share it with your children. You know why? Because it's a joy that it's special to share it with people who I have, the age group that I worked with long time back, to show you that if you believe, anything is achievable, even learning cash flow statements, which is a small step to your greater achievement. So let's get on to the slides. I think, Rahul, you're going to help me with the slides. I'm not going to spend too much of time on me, though I love, that's my favorite topic, me, but we're not going to talk about me today. We're going to talk about cash flow, okay? Before you even move to the next, we already have given away one trivia question, but I wanted to ask you something. If you can unmute and answer, I would really love to hear you, okay? So tell me, at home, who manages cash, mom or dad? Anyone who can answer, or you can use your, I know most of you would say, I know who you're going to say, but you can say it.
Yeah,
who manages cash?
Yes? Good afternoon. So my mother manages the cash flow statements and all.
At home?
Yeah.
She manages the cash flow. So any pocket money that you need, you would definitely reach out to mom. So what would that be? Your pocket money, would it be an inflow or an outflow? For mom, for you it will be what, and for mom it will be what?
So for mom, it would be like, she would be definitely asking reasons for the purpose of taking that money, and for sure she would be requiring some statement ki, why are you taking this, and why, in what purpose, for what purpose are you going to use it?
Okay, I'll hold you there. I'm asking you, when you talk about cash flow, okay, let's get into the things, and I'm going to come back to this question. I'm going to come back to this question as we talk more and more about it. What do you think is a cash flow statement? Is it a financial statement or is it a non-financial statement? And I want you to answer in the chat without consulting each other, like a fastest finger first. Quickly tell me, is it A or is it B? Wow, I'm getting answers. And obviously, right? The title gave it away. So it is a real trivia question. We said financial cash flow statement. So it was a no-brainer. Let's go to the next trivia question. Okay. So before we go to further, what is a cash flow statement? You've already answered the first line. It is a financial statement. What does it do? It collects all the data. When we say aggregate, it collects all the data relating to cash inflows. So this was my question to the lady who had answered, the little young lady who had answered earlier. So for mom, when she gives you pocket money, what is it? Is it a cash inflow or is it a cash outflow? For mom.
Cash outflow.
Cash outflow, not nice, right? But for you, what is it?
For me, it's cash inflow.
You got it. You'll have understood what is cash inflow and cash outflow. So that is it. Anything that comes into the business, into the product is an inflow. It can come in various ways. And as it come into our cash flow statement is something that we are going to learn. It says for the ongoing operations and external investment sources. So what is this ongoing operations? You keep hearing a lot of jargon, a lot of terminology, but what is this operations? Simply, in simple words, the funds that you need to run your business. The funds that you need to run your business. And remember something, cash in hand is as useful as the dress you're going to buy, the shirt you're going to buy, the game you're going to buy. It's as useful as that. Any extra cash you have becomes idle. So for a company, for an organization, for a business to have that idle cash is not useful. They would have to invest it because they have to generate more and more income. So remember, cash inflows are where when you run your business or when you invest money and you get something out of it in terms of cash, it's a cash inflow. And when you spend money, when you use that cash to actually get things like an asset or to get services of people in terms of paying salary, that would be a cash outflow. Are we good here? Yeah? Okay, I'm going to take that as we are good and we'll go to the next slide. Okay. To prepare anything, it has to have some use. Before I move further, remember, a cash flow statement is one of the three important statements that an organization, or at least a joint stock company, has to prepare at the end of the year. One is the balance sheet itself, and of course, the income statement. And earlier, in the old traditional way, they would stop with, after income statement, they would prepare the balance sheet and they would stop. But as they progressed in the world, they understood we need to understand more aspects in our finance. So that is the reason the concept of cash flow came in. And what are the objectives? What are the advantages? What are the benefits? One is your cash flow information helps you to understand liquidity and cash position. What is liquidity? In simplest of terms, that which can be easily converted to cash or cash itself will help you to pay your short-term obligations. That which can be converted to cash or cash itself will help you to pay off your short-term obligations. I will keep reiterating some sentences and I want you all to remember. Too much of cash, not good. Too little cash, dangerous. So to decide what is that right amount of cash, you prepare cash flow statements, you analyze the data, and then over a period of time, you perfect as a company, as a finance person, you perfect how much of cash is near perfect. We are human beings, we cannot assume and determine what is the exact perfect, but we can definitely come to that near perfect. And that's what the cash flow statement will do. How much do you need to pay off your short-term obligations? How much of cash do you need? Depends on your business. For example, if you're a construction business, you will have laborers. They will not want Google Pay or checks. Doesn't make sense for them. Of course, today everybody have Google Pay because all have smartphones, but that is also a kind of cash. So you need, because you have cash at bank to pay Google Pay too. So you need to remember that for a construction business, more cash is required. For a business like FactSet, which deals in services and pays salary from account to account, we do not need too much of cash. Are you getting the picture? So what is FactSet? Before I move on, I'll tell you. FactSet is a service provider. It provides financial information for investors to make decisions, to invest in stock. Okay, that's what FactSet does. So it's a service company. Construction company is a different kind of service company. Now, Apple is a manufacturing company. They produce products. So how much of cash do they need? They have wages to their factory workers. They need cash for that. So you need to understand for what do you need cash. As I told, the second one is leading to the first one. I'm going clockwise, starting at the cash flow, and the clockwise says short-term planning. So short-term planning is something I covered. Highlighting cash flow from different activities. We'll talk about the different activities and how that is useful. I told you too much of cash is bad, too little cash is bad. Okay, because cash in your mom's purse doesn't earn any interest. Okay, and the more cash mom has, the more pocket money all of you want, right? So that's the reason cash in mom's purse is no use. Cash in bank will at least, depends on which account it is in, will at least earn interest. So how much of cash is very important to note. Okay, and you have every person, I think everyone knows that whether it's your mom who manages cash or dad who manages cash or whoever manages cash at home, there is a budget. How much are we going to get in? How much can we use? How much do we need to set aside for more future expenses. Similarly, a company runs, a business runs. What they have a budget, they have a scope of how they have to spend, and this cash flow statement will help them understand that budget as against the budget, how they are functioning. Are we good? Are we good or no? You can just show me a thumbs up because I can see your video. Fantastic. Let's go to the next slide. Okay. Before I move to this, I think we have a trivia question. Yes. Components of cash flow statement. So let's go to the next slide, Rahul. How many components does a cash flow statement have? 1, 4, 3, none of the above. Quickly on the chat. Okay. So yes, we do have 3 and let's talk about them. So the 3 are operating, financing, investing, or all of the above. Okay, I just mix the particular order. Let's go to the next slide, please, Rahul. I will read the order according to what is given here. Is it financing? Is it operating? Is it investing? Or is it all of the above? You already mentioned it is 3. So are all of these 3 components there? Fantastic. This is going to be a very quick session. I wish when I had students, they knew everything like this. Okay. So yes, you are absolutely right. It's all the 3. Let's go and understand more about them now. Shall we? Okay. So Rahul. But before we do so, I really love Investopedia. Even now I use it when we are working, and especially when we go for interviews, we prepare ourselves for interviews. Okay, you'll be surprised. We do prepare ourselves for interviews to understand whether we are very sure of our knowledge again after so many years. So let's watch the Investopedia video.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies. Ed makes his living running Ed's carpets. For Ed, cash flow is essential to the survival of his business, as well as his personal finances. Having ample cash on hand ensures that Ed can pay his employees, his creditors, and himself on time, keeping the business afloat. The same goes for Ed. He needs enough cash in his personal bank account to pay for his house, his car, and other personal expenses. Whether we are talking about Ed or his business, there are generally 3 types of cash flows. 1. Operational cash flows refer to cash received or spent as a result of a company's business activities. For example, a business like Ed's Carpets brings in cash by selling carpets and sends cash out to pay employees and suppliers. Similarly, Ed pays himself a salary, providing cash flow to his personal account. Cash will flow out to pay for his expenses, such as food and housing. 2. Investment cash flows refer to cash received or spent through investing activities, basically the purchasing and selling of assets that will help grow the business, or in the case of Ed, assets that will help increase his net worth. 3. Financing cash flows refer to cash received through debt or paid out as debt repayments. For a company, issuing stock, paying down debt, and repurchasing shares would count as part of financing cash flows. For Ed, financing cash flows include any cash coming from loans or other types of debt, as well as payments going to pay down debts. If Ed's business comes up short on cash and is unable to pay its obligations, it will experience a cash flow crunch. To avoid insolvency, Ed will have to arrange some type of financing or bridge loan. A similar situation in Ed's personal accounts would also have disastrous effects that could lead to personal bankruptcy if the cash flow crunch persisted. For this reason, it is important that businesses and individuals manage their cash flow carefully and set aside emergency reserves to cushion any unexpected events.
As I said, I just simply love Investopedia. It really gives us a very nice insight and a very nice way of learning. So cash from operating activities, right? It says, as I told you, remember, operation is running your business. Anything that helps your business going, anything that is recurring in nature, anything that is not long term but is repetitive, that is operating expenditure. Okay, so you have to pay salary to your employees every month. You have, let's say you do not own that place that you're working, the office that you're working out of, you have to pay rent for that particular place. All that becomes operating expenditure. In case you are a store, then to buy the goods that you're going to sell, the purchases become operating expenditure. Okay, so that is the cash that goes out for that is a cash outflow. That is what you have to remember. So that is a cash flow. Purchases or sales of a product, increase in the current assets or liabilities when you pay off your debtors. I've also got for you some of the examples. I heard that you would like to know more examples as to, for example, for a finance company, cash received from interest and dividends is a cash inflow. Sale of securities is a cash inflow. Cash paid for interest, purchase of securities, all of this is a cash outflow. For an insurance company, the premiums that they receive, the claims that they receive, that would be a cash inflow. The premiums that they pay, the claims that they pay would be a cash outflow. Similarly, for a real estate company that actually lets out its real estate, rent received would be a cash inflow. Okay, so that is something that you can understand for different kinds of company. For FactSet, it being a provider of service, we get what is called subscription for our services. They have to pay us a fixed amount to use our product. That is called a cash inflow for us. Okay, we have to pay our employees the salaries. That is a cash outflow. Okay, so that is an operational activity to run your business, day-to-day activities, month-on-month activities. So if you can go on to the next slide. So here you have classification of business activities. The first one is operation activity, and under it you have cash sales, received from debtor, commission and fees, royalty. Cash outflows are purchases, payment to creditors, operating expenses, wages, income tax, and manufacturing expenses. I'm sure you know all of this, so let's go ahead. I can see some hi-fis going on there, so I'm sure you have recognized those aspects and you were very thrilled about recognizing that. You know, finance loves this. I do not know people who prepared accounts or prepared the books of accounts. I think when you learned the initial journal entries, you got questions as to why is it this way? Why not the other way? You have to understand that accounting is an art and science. The art part is somebody has developed it. Now that has become a science. It is what it is because it is so and it is tradition. So that is something that we follow so that there is a commonality that we follow across. So what is direct and indirect method? Let's look at direct method. Direct method, when you look at, I want you all to pay attention. I know that this part of it you can understand absolutely, but how do you remember it longer? Simply remember, direct method is literally looking at how much of cash has come in, how much of cash has gone out. Okay, so you have to look for transactions and you have to look for what has been the inflow and what has been the outflow. Do you get that? Okay, you have to look for transactions and you have to look at what has been the inflow and what has been the outflow. Is it easy? Not easy, because you have to keep a track of each and every transaction. So you have to go back to your cash book, you have to go back to your journal entries, you have to go back to everywhere you had spent cash and trail everything and prepare the direct method. The indirect method, as I told you, you prepare 3 financial statements at the end of the year. You prepare your income statement. From that, you get what is your net income. You take the net income and you make adjustments to that net income. That is the indirect method. So even though the word says indirect, it is the easier method. So please remember, indirect is the easier method. Direct is the more difficult method. Why? because you already have the income statement ready. You take the net income and then you make adjustments. And all of us are experts at making adjustments, right? Final accounts, remember, final accounts with adjustments, final accounts without adjustments. You prepare the balance sheet and you take from the trial balance what is within the trial balance, what is outside the trial balance, you make adjustments. Similarly, or you remember bank reconciliation statement. Have you learned bank rec? Have you learned BRS in your schooling? Anyone? Bank reconciliation statement? Yes, no, yes, you have. So you simply do that with your indirect method. You take your net income, anything that is non-cash, okay, expenditure, you add back because that is actually literally you have cash in hand. Anything that is non-cash revenue that you have shown that you're going to receive in future, for example, advanced accrued income, you will subtract it because you do not have that cash in hand. Okay, so simply remember, direct method is you take the actual transactions, indirect method is you take the net income and you make adjustments. Let's go to the next one. Okay. This
Excuse me,
is
ma'am.
your cash. Yes.
Ma'am, can you just explain in brief what you mean by making adjustments?
Okay, what do I mean by making adjustments? So you take your net income from your income statement, which is your net profit, and you add back non-cash. When I say non-cash, depreciation is a non-cash expenditure. There was no cash outflow. And in this net income, there has been an adjustment for depreciation. So you add it back. So if you have 1,000 rupees as your net income, 100 rupees was your depreciation. So your 100 rupees, there was no cash outflow. So you add back 100 and now you show that the new cash amount is 1,100. Let's take a non-cash expenditure income that we thought. In future, in the next 3 months, our accounts receivable is 200 rupees. We have showed it as accounts receivable and that is impacted, or rent receivable or some kind of factor that is receivable in future, not now. That is not a cash inflow. So you have to deduct it from your net income. So 1,100 minus 200, now you have 900, which is your actual cash in hand or cash that you have, and not that earlier 1,000 that you thought of. Does that help?
Thank you so much.
Okay. So that's what they're talking about. The cash receipts from sales, commission, interest received. This is the direct method. You have to actually go and look at all your cash transactions. Have a glimpse at it. You're used to it. Okay. Let's look at the indirect method, which I said is the easier method, more practical method, though the usage is dependent on what a business wants to follow. The IFRS GAAP rules say that you can follow whatever you want. Let's go to the indirect method, the next slide. What I was giving as an example, net profit before tax, you have depreciation, loss on sale of fixed assets, loss on reevaluation. All of these you have taken while computing your net profit. You add it back to get what is the actual cash in hand. Some futures which you thought you were going to receive, you have accounted it for because you've used the accrued method while you have prepared your accounts, not the cash method. So in that case, all of these receivables which are not yet received, you will again deduct that. And cash generated from operations is what you get. You will also take into account something that may not have been taken in the income statement, like interest paid or taxes, and you get what is the actual net cash now available for operating activities. Okay, so let's move on, please. Okay, so the indirect cash flow method starts with non-cash transactions, net income, all of the above. Let me see the answers in the chat box. Okay, so you're answering together. Starts with net income. Fantastic. The direct cash flow method starts with cash transactions, non-cash transactions, none of the above. It starts with, Fantastic. Cash transactions. So you know your stuff. Fantastic. You are truly achievers, junior or not. Okay, let's go to the next. Thank you so much. So here we have a simulation given to us. Okay. So just look at it. Look at this particular statement and you're going to think about in operating. What all would come under operating? So you have your balance sheet and you also have some details given you below. 26,000 paid as dividend. Provision made for depreciation against machinery was 27,000. 36,000 as of 31/12/5. Find out the cash flows from the operating companies. Now remember the cash at the beginning of the year was 4,000. At the end of the year is 3,600. You also have that's it. You have dividend, you have depreciation, and you have the cash given in your details. Now let's go to the calculation. Let's not just spend too much of time here. We have quite a few slides to go and we want to spend more time in the workshop, that is in the breakout rooms. So let's go to the next slide, which is the solution. Okay, can you see? We started with the net profit. Rahul, you'll have to bear with me. I'll also be going a little back and forth to slide 30 again. Okay, if you can go back to that, just look at where did we get the net income. Okay, how did you get net income? Anyone? How did we get net income? You can unmute if you want. How did we get the net income? It's not obvious. I cannot see it here. Okay. You have the closing capital and you have the opening capital. So that when you subtract the closing capital from and you subtract the opening capital or subtract the opening capital from the closing capital, you would get your net income. Let's go back then to the next one. That's how you got what is your net profit before tax, adjustment for dividend, depreciation you have to add back because it's non-cash. There was no cash outflow. Then you have the current liabilities and income from debtor is 5,000, decrease in stock 3,400, and you finally arrive at 40,600. We'll go a little faster, but we will also conclude a little later as to how do you go about all of these. When you understand financing and investment, you'll be able to segregate even more better. Okay, let's go on to the next one. Okay, so investing activities. Please be very cautious. What is investment? So investment can be either purchase of your assets, and the inflow can be when you sell your assets. So let's say you sold your asset, which was earlier bought for 10,000. Now, after all the depreciation, etc., you sold it for 8,000. So the value as after all, book value was 10,000. You sold it for 8,000. Okay, and you have a profit of 2,000. Operating inflow, you will not take the 8,000, which is the sale of the asset. Remember, the sale of the asset of 8,000, which was, you will not take it as operating because it's not a consequence of your operations. It is a consequence of your investment. How? Earlier you bought the asset. Now you're selling the asset. When you bought the asset, it was cash outflow. And when you are selling the asset, it's a cash inflow. So investment also can be when extra cash is with the business and they decide to invest that by advancing loans maybe, or doing something that will earn them some kind of income like interest. That also can be an investment activity. Let's move on, please.
Ma'am, so all the money that comes from sales, that is an investment activity?
No. When you say sales, whenever we say sales in finance or commerce, we are referring to it as one word for goods. Okay. So what sale are you talking about? For Apple company, the sales of its phones, okay, is cash inflow of operation. So that will go as operation inflow, okay, in the computation of your net value. But here, the machines that make those phones, when it gets older and you sell it, that will come under investment. Is that clear?
Yeah.
Does that help?
All right. Thank you.
Okay, good questions. I like this. Okay, so here you have it. Sale of fixed assets, sale of investments. Like, let's say the company did not want to have its cash idle. As a company, they have invested in shares. They have purchased certain bonds.
Sorry
Yes.
to disturb you. Ma'am, why do we need investment?
Because cash in your pocket earns nothing. Okay, let's say a company has overestimated what cash they want and they have that cash with them. What should they do with that cash? Okay, and all in some 2000 years ago, that businessman would have hid it under the floorboards. Okay, but that doesn't work anymore because cash lying idle will not earn you anything. So that's the reason even a company has to be intelligent. If it has excess cash, it has to invest it. So it has an obligation to earn money for its owners or shareholders, as the case may be. Does that help? Why do you invest?
Yeah, ma'am.
But you have to be very cautious. You cannot be saying that, oh, all this cash is idle, I will use all of this cash to invest. That is where liquidity, how much is extra, is what you will learn with cash flow management. And that's how cash flow statements help you. So as I was telling, sale of investments, interest received, dividend received, blah, blah, blah. You can see that particular thing. I like that intelligent group, which is room number 11. They are taking pictures of the slides. Are the other rooms doing the same? Because you have to be as intelligent as room number 11. Okay, they're taking pictures of the slides because they are going to use that for their project. Very intelligent, smart use of smartphones. Okay, let's go to the next slide. Okay, so here you have cash flow from investment activities. You see here, you add back anything that is from a sale of a machine, sale of an investment, patents, dividends, rent. Okay, rent, when will you receive rent as an investment activity? If you're a real estate company, then you will receive rent as an operation activity. But if you have excess rooms available, excess space available, you do not want that space to lie idle, you rent it out, that will be an investment activity. Please remember, how do you identify as operations and how do you identify as investment? Now, during the pandemic, everyone worked from home. What do you think our companies done with the entire huge offices that we had, where they're just sitting idle? There were some offices that had to work from office. They couldn't work from home because their work was as such. So what are intelligent, some of the offices done were they sublet, okay, because they have taken all of these on long leases. So what they have done is they have sublet. That rent which they receive becomes an investment activity because their business is not to let out places. Their business is something else, but they had let it out because it was lying vacant. So purchase of a machine, purchase of goodwill, purchase of investment, all of these are investment activities. Can we move on, please, Rahul?
Excuse me.
Yes.
Ma'am. So, ma'am, can we put it in that way that investment activity is something we are not fully based in or fully engaged in, but it is something we are doing side to earn extra money?
It is both. Okay.
Okay.
Now you purchase your asset absolutely related to your business. Okay. You have excess assets. You utilize that assets in certain ways that is outside of your business. I repeat. Okay. You purchase your assets. You use your assets for your business. Okay. That is also investment. You use your excess assets by not letting them remain idle, and you either rent it out or you utilize it for some purpose. Cash is also an asset, remember. Cash is also an asset. And when you have excess cash and you use it, that is also investment. So either for directly for your business or because it is lying idle, you use it, both of it is investment. Does that help?
Yes, thank you. Thank you.
Fantastic. I like the question. Yes.
Ma'am, what is sale of investment?
So sale of investment is, as I said, a company realizes that it needs just 10,000 to maintain its liquidity, but we have 15,000. Okay, I'm using very small amounts. You should be thinking of 10,000 crores, 15,000 crores if you think of large companies. So I'm repeating again, we have 10,000 which we need for liquidity purpose. That much is a cash which is ideal. Okay, and we have 15,000. So we realize that we do not need this 15,000 for another few years, but we do not have anything to buy because we have enough of assets. So what the company does is they use this 5,000 to buy shares of other companies that are doing very well, or they buy bonds of other companies, or they invest it in some way or the other so that it earns money. Okay, so when it invests this 5,000 in the shares, and later on when the shares are doing well and they sell it, the profit which they earn, that will be something that is a sale of that investment, because it was directly related to investment. That will come under investment activities. See, for small businesses, right, they usually keep only that much of cash that they need, etc. It's very easy to work out. For large companies, they are answerable to their shareholders. So having too much of cash, their shareholders will ask them, what are you doing with this cash? Please earn extra money for us. So they invest the extra cash into other companies' bonds and assets. Okay.
Thank you, ma'am.
Yep. Welcome. So can we move on then? Okay. Financing. Tricky again. We said operating, running the business. Investing is sowing a seed so that you can earn more money. What is financing now? You have cash inflow and outflow is fine, but to maintain your overall business, you need capital. If you cannot get it from capital, you need borrowings. And the maintenance of this capital and borrowings and the actual inflow and outflow of these capital and borrowings, the raising of funds and issuing of debt, that is what is cash flow from financing activities. Let's move on to the next one. Okay, so this is where I was talking about. Look at the cash inflow. Shares that are issued for cash, debentures, proceeds of long-term borrowings. That was when you take a loan from the bank. It's a cash inflow. Okay, and payment of these loans, payment of the interest on these loans, redemption of preference shares. Now it's time to redeem your preference shares or to repay your bonds, debentures, payment of dividends, interest paid, repayment of finance, lease liability. All of this will come under a cash outflow for financing activities that help you finance your business. Okay, let's go on to the next slide, please. So here you have issuance of common stock, preferred stock. What is treasury stock? So when a company decides it has too many shares in the market, it decides to go for a policy called buyback of its own shares. The company cannot be its own shareholder. So it has to park the shares as treasury shares. That is what is treasury stock. So you have payment of long-term debt, treasury stock, and then you have payment of dividends. We'll move a little faster because these are concepts that you have a hang of. We'll just revise here. So this is based on the case study that we had there. We had repayment of a bank loan there and payment of dividends, which are financing activities. And therefore, from financing activities, you have 11,000 as net cash. Okay. Now that you have, I just want you all to remember something here. You'll have seen operation, you'll have seen investment, you'll have seen financing. Remember, each of this will become a detailed analysis for people who are doing management reporting in future. For those of you who are doing management reporting for your companies or for your organizations or for your own businesses in future, each of these sections will become an in-depth analysis to understand how you are managing your cash, not just the net cash. Each of it will become important for you to analyze. Okay, let's move on, please. So this is the final format from your operating, from your investment, from your financing activities. We'll move on. You will get these slides, your facilitators in your breakout rooms will have the slides available with them. And you can again refer to any of the slides when you're working on your problem that will be given as a case study. I'm going to skip this case study here because I am believing that you are knowledgeable of cash flow and you understand how to apply what in each place. So we'll move on to the next one. Okay. This were some of the asked questions that came about from the students here. Your teachers had shared it with us. One is, how do you distinguish between what is fixed and what is variable? You purchase a machine that is a fixed cost. That is something that does not repeat. Okay, it helps you to earn your income. Okay, and it does not increase or decrease based on how much you are producing. The cost per unit will remain the same. But whereas a variable cost is something that repeats in nature and that will change on the number of units. For example, if you have your employees for certain tasks for the entire year, you know what is your fixed cost, that this is your cost. It's not going to increase. For that year, you are very clear as to what is your salaries. But for a manufacturing unit, it's based on wages. So the cost will increase upon if you have more, tasks to churn out. If you have more units to produce, then your per unit cost will be fixed, but the total cost will keep changing according to how much you're going to produce. Let's look at it. Okay. So you have the machine that makes the Apple phones. The per unit cost of electricity to run that machine will remain the same practically. It will not change. The cost of that machine will not change. Let's say you make 5,000 phones, okay, with that particular machine. I know it's an assembly line, but just let's imagine you make with one machine the entire phone, okay? With that one machine, you make the phone, you make 10,000 phones. Let's say the capacity of that machine is 10,000. So the per unit cost will not change, okay? But the number of people you need may be now 20. But if you want to make 20,000 phones, now you need 40 people. So your cost is changing. So that was earlier, it was the machine cost is fixed, but the number of people you pay, the raw material you pay, that becomes variable. Okay, so that is fixed versus variable. Let's move on, please. Break-even point, simple. I'm not even going to go to that next composition of what is break-even, where your cost meets your revenue. You have reached a zero profit point. Neither are you getting a loss, neither are you getting a profit. Okay, I'm going to use FactSet as an example. It's a service industry. So we have certain costs. We have applications to collect information and organize this information for our clients. We have to pay salaries. We have to pay rent for the place that we work from. These are all our expenditure. Okay, let's say it is $10,000. Okay, and we have actually got a client who is buying our product for $10,000. We have broke even. Okay, there's no profit, no loss. Whatever I'm spending, I am just getting back. I'm just meeting those particular expenditure. For a new startup, you will calculate by what time I can meet that break even. That will be a point where I can say from here, I will start earning my profit. Okay. So when I get a new, with the same expenditure, with the same number of people who are working in the same office that I'm working, paying the same rent, okay, I get another client for 5,000 rupees, $5,000. So now how much am I getting my subscription? $15,000. My expenditure is not changing because I have the same number of people, I have the same office that I'm working in, which is $10,000. So now I'm earning a profit. I moved beyond my break-even point. Okay, that's something that you have to understand in terms of the break-even point. I'm going to skip that example and move on to the next slide. Okay. Thank you. Now we will skip the example and move on to the next slide. We are busting our time here, so I'll move a little faster. Okay. It's where your expenditure meets your revenue. Okay. So the next one is return on investment. It's in simple terms, the return minus the investment divided by the investment will tell you whether you are in the positive, you've got a return or not, and what is the percentage of return. It's a simple formula for your percentage. Okay, that is your return on investment. So Rahul, we'll skip the next slide. It's a calculation slide. We can share it. The teacher said that they will share some of the slides with this group later. Okay. For want of time, and so let's ask some questions now. Okay. I know question answers is not fun for everybody, but I like the enthusiasm of this group. So let's go with the questions. The first one. This is not a part of what we have learned just now. These are additional information. What is the formula of quick ratio? I think it's giving away the answer here in the, so tell me, is it A or is it B? Okay. Current assets minus current liabilities or quick assets minus current liabilities?
Ma'am, option B.
Option B, which is quick assets. I said that the answer is giving away the clue. Okay, so you are right. Option B. Let's go to the next one. Okay, let's get, what is the formula of cost of goods sold? What is the formula of cost of goods sold? That's A and A. So let's treat it as A and B. Okay, is it A or is it B, the second one? Okay, tell me. You should know this. Fantastic. Opening inventory plus purchases minus closing inventory. Something that is ingrained in all of us who learn finance. Let's go to the next one. Fantastic. Okay. What's the formula for gross profit margin ratio? Okay. Revenue minus cost of goods sold by revenue, or is it gross profits minus operating expenses by revenue? Okay. Is it A or is it B?
Ma'am, it is option A.
Fantastic. Revenue minus cost of goods sold divided by revenue. You know that what is gross profit, and you will always remember what is the gross profit ratio. Fantastic. Let's go to the next one. What is the formula for profit margin ratio? Net income minus preferred dividend by weighted average outstanding shares, or revenue minus operating expense plus non-operating expense minus interest expense minus income and taxes by revenue. So which is it?
Option B.
Fantastic. I like the competition among the rooms. This is going to get very exciting.
Option
Let's
B.
go. Fantastic. You are super. Let's go to 10. How many solvency ratios are there? 4, 2, 5, 3. Yes, it is 4.
Be 2.
No, it is 4. It is 4. So for those, I'm going to just give you the answers, but if you guess something different, you have to, this will be your follow-up for after today's session. Go and quickly check after the session today, what are the solvency ratios? Okay. And I think we should be done.